Hi, students. This week, we're going to talk about cryptocurrency trading strategy. So trading, a robust trading strategy, there is investment. You buy, and then you do fundamental analysis, and you buy and you forget about it. But trading is different. We didn't care about fundamental. We care about the price. What's the price now? What's going to be the price tomorrow? So trading is a short window, non-fundamental analysis. So what is a trading strategy? Today, we're going to talk about key factors when analyzing trading strategy, defining trading strategy, list of trading strategies. I'm going to go through the list, make a stop here and there, but you have to read it by yourself. Market trading timing, type of trades, reviewing key trading strategies, and then enter and exit to crypto and the financial market. How to be a good trader? You have to be emotion free. What is that emotion free? You maybe had a bad trade. That means you should not feel like you're not smart or you're not doing good, or you would start forcing things. You take more risk just because you want to cover your losses. Just take every trade. If you convince this is a good trade, then do it. And that needs a discipline. Be a soldier. That means discipline. Like if you have a strategy, stick with your strategy, even if it doesn't yield in the first 20 minutes or an hour or a few days. I didn't trade all of the portfolio. If you have $1 million, for example, just to make a number here, you cannot trade all the $1 million in and out and buy this and that. The most of the portfolio should be based in fundamental and trading 10 to 20% of your portfolio. What is a trading strategy and why we need a strategy? A trading strategy is a contingency plan. Like if this happens, we'll do this. If this happens, we'll do that. And it reflects all the possible market condition outcomes. The trading strategy reflects systematic methodology, namely rules and criteria how to trade. Why does one need a trading strategy? This question is like the Constitution. Why we need the Constitution? Trading strategies give you a platform how you will do for given situation. Again, we want to take the emotion out of your game, out of your investment or trading. To do that is to have a framework and a strategy that work within this strategy. How to analyze a trading strategy? First, what we're going to do today, I'm going to show a few trading strategy quickly. There are a lot, like there are 50 or 60, but I'm not going to go all those. I'm going to cover the main ones, mention them, and cover maybe one or two. In the other assignment, you will have a 3 trading strategy. I will show you in depth how to do the trading strategy and how to make a trades, and you will have a homework to replicate the work using different crypto. So how to analyze a trading strategy? If somebody told you about trading strategy, here are the questions you have to ask. What is this trading strategy? What is the mathematical model? When to use it? Bear market, bull market, the advantage and disadvantage. These are the 5 items that you need to ask or think or research when somebody presents a trading strategy to you. Type of trading strategy is scalping, day trading, swing trading, momentum, volume, all the above. So I'm not going to talk about those, all of them. I'm going to talk a little bit here and there, like social trading also. But in the other assignment of the class, we're going to focus on the 3 main ones for crypto. Day trading is you trade within a day, you buy and sell during the day, you buy when it's high, going down, and then sell on this. Like for example, today, it's a Wednesday when the Fed report their policy. So I was on the hold a few minutes before Joe Powell start talking, because when he talk, the stock market goes down. So I sold before before Powell start talking. And then I waited till he finished talking, and then I bought again, because whenever Joe Powell talks, the market goes down. That's a day trading, basically. Swing trading is you trade in and out, is a momentum-driven approach to trading that can be used in both short-term and long-term. Scalping is like Muhammad Ali, the great boxing, when he said, sting like a bean, like in the scalping, you have a small windows, very short windows, like a boxer doing like this, and then Ali give you a undercut. So it's a small window where you have to go and make a small profit between the bid and the ask. For example, somebody willing to pay X amount of dollar, 98, say $1.44. Somebody want to sell it for 98.02. So you make that and you get 2 cents a spread. And as I said, this is a small window of a trading. Like this is a buyer, this is a seller, and between those you can make a trading. That's a scalping. Long short trading strategy. Like for example, if the market become to be very volatile, you will ask yourself, is it the market, is the Nasdaq will be more volatile than the Dow? If so you can go long Nasdaq, short Dow. The idea here, the Nasdaq has return of aggregate plus return of the tech, because the Nasdaq reflect the tech company, overweight the tech company. The Dow is aggregate shock, aggregate return, plus return of industrial. So if you do long, that means you buy Nasdaq and you short the Dow, then basically the aggregate cancel each other, and the return of the tech will be minus return of industrial. So this strategy also good in bear market, because in bear market, sometimes the market going 4%, 5%. If we are in a bear market, then the aggregate shock will go, and then all what you lose is just the difference between the tech and the industrial, if there is a difference, negative or positive. Also good in the bull market. In the bull market, no, you would just want to go long, you didn't want to short. Golden cross, I'm not going to talk a lot about it, but in the other video, I'm going to talk in depth about it. I'm going to go short and sweet here. We do a moving average, the 50 days versus 200 days. 50 days reflect the short-term sentiment. 200 days reflect the long-term sentiment. When there's, and the point when the blue and the black here, we call it golden cross, when the 50 days hit the 200, that means the stock going into momentum. This is a buy. When we go in the opposite, when the 50 going down and the 200 going up, this will be the sell, and we have a more focus on this golden cross strategy in the homework in the other video. The advantage, a great way to filter out market noise, and the disadvantage, easy to get website. Momentum-based strategy. So this is a very nice, and there are many momentum trading strategies. Momentum is a great one because there's something in behavioral finance called the herd. When somebody move, everybody follow the mover. And if somebody company doing good, that means start piling up. A lot of investors want to buy it and going up. We saw that with Tesla when they have a 750% in 1 year. So it was a momentum. Buy at support trend, all resistance trend. Buy when HMA moving average momentum turns bullish. So these are the momentum-based strategy. The advantage can be used for both long-term and short-term. The disadvantage, your trades can get chopped around a lot because the momentum can go all the way, but when we get maximum, it's going down fast. Volume breakout strategy, often mixed with the momentum and mean revision. Here's example I have for you. The advantage, when we mix with the momentum and mean revision strategy, they can increase profitability and win rate. Disadvantage, volatile. Arbitrage strategy. People talk a lot about arbitrage, but there is not a lot of arbitrage. The truth is, arbitrage is you go couple positions, whatever happen, you're gonna do a profit, and that's not a lot often happen unless you're you can do that between European market and the US market because they didn't open and close at the same time. But Apple is also traded in different market. So you can get the difference between these two markets, but also that not a pure arbitrage. But here's example, not related to stock market, but give you an idea about arbitrage. Warren Buffett, when he was 6 years old, saw that he could profit from arbitrage. He would purchase a 6-pack of Coke for 25 cents and sell each barrel for 5 cents, that will give me 30 cents and he will win up a profit of 5 cents. So the idea is you buy the 6 and then you sell it individually by higher price. So arbitrage trading and find a path to sell with a profit before you make a trade. And then we have a trading based on news and the fundamentals like earning announcement, CEO firing, hiring new CEOs, all of those are examples. Advantage can be a great way to make a huge return. Disadvantage, hard to define, exit, entry. But later on in this presentation, we're going to talk about entry and exit. The trading signal, this is interesting. So there's the candle that we taught last week or in the previous video, give you ideas when the markets are polished, when it's bearish. So this all we call it signal. And we talked about 3 different signals, but there are many bearish, bears, and cycle signals. Social trading. Social trading is you don't want to live between fear and greed. You want to be always in neutral because emotion control us. There are 2 types of emotion. 1, you feel bad about yourself. You're not smart and things. 2 is jealousy. Somebody did better than you and you start feeling jealous and then you want to compensate the gap. So do your strategy and stick with the strategy and don't look what others doing. Focus on your strategy. Don't be a social trader. Mean revision, that means the price or their price going over a mean or the return going through a mean. And when the return is way below the mean, then you buy. When it's above the mean, you short, you sell. And the mean revision disadvantage is highly volatile environment. If proper risk mitigated tactics aren't used, it can destroy your portfolio. Statistical arbitrage, it's another one. I teach it, but I don't recommend that. It mitigates the rates, it hedges your portfolio. You have to do some option. I don't recommend that, but people like it. Like for example, if there is an earning for Facebook, Twitter now out of the trading, but before when Twitter was available. So you can sell your Facebook and buy Twitter because if Facebook has a good earnings or Meta, then Twitter also will have a good earning. Now we have a snapshot. If a snapshot have a good earnings, then you can buy Facebook or Meta and then get the return up. But if snapshot has a bad earning going 20% down, your Facebook will go down 3 to 4%. That's a statistical arbitrage. Automated trading. This is it can be a full class, full semester. And this is growing up a lot because the fintech technology, most of the trades are done by computers and developed by programmers who write the computers. But the retail investors don't have a automated trading. They don't have a computer or software to run for their trade. That's the reason I said in the beginning, a few hours of the market, the retail investors buying and selling. So you work with them, you trade with them. In the afternoon, when the institutional come into the market, become to be more automated. The disadvantage must know how to program in order to develop the system. And that's usually institutional companies doing that, investors, institutional investors. What is stochastic indicators? The stochastic indicator is a technical analysis indicator, like a scalator. And values ranges from 0 to 100. If it's above 70, it's overbought, below 30, oversold. But it varies, so you have to be in, exit, and enter. But this is very complicated, and it's better to use it with automated trading strategy. So it's more for an institutional, less for a retailer like us. Now, crypto run by retailers. So all the best 3 strategies that I recommend in the class are because most of the traders for crypto are retailers. So in the other video, I will focus on these 3. But this is, again, available for traders, especially institutional. How to use a stochastic? Buy when the fast MA and slow MA are less than 20, then oversold. So from 0 to 100, below 20 is oversold, and then buy it. stochastic overall assessment of here we have a overall level and then overbought, oversold. So the numbers are here between 0 and 100, and then when it's below 20, you buy, above something you sell. Bollinger Band, I'm going to talk about this quickly because I have a video only about this. Bollinger Band, you have an upper band and lower band, and then the price going between the upper band, the green here is the upper band, the lower band is the yellow, and this is the price, the green here is the price. And then you buy if you're close to the lower band, and you sell if you're close to the upper band. But we're going to talk about it more in the other video, and here is the mathematical model, how we calculate the upper band from 1 standard deviation plus, the lower band -1 standard deviation or 2 standard deviation, depends how you want to program that. And next week, when I teach that, I teach you how to program that. You want to have a 1 standard deviation or 2. The number of standard deviation also give you some flexibility to have a more robust trading strategy. But if you make it very, very robust, you end up not trading. So you still have to have some flexibility. How to use Bollinger Band when you're, as I said, when the price here, for example, so when the price getting, like when the price is far from the upper band, then you sell it. When the price is near the lower band, then you buy it. But we're going to talk about this in the other video. And then there is a Coulter channel, which is upper band and lower band, the same concept, different way of calculating that. And here is a 2 ATR, and the ATR is the average true range. And then the calculation here is example, buy when the price is the lower band, and the same, the idea, two envelopes, buy when it's near the below envelope, sell when the higher envelope. You can do also a band, but the question how you calculate that. When we talk next week, when in the other video, in the other video about Bollinger Band, for example, I'm going to take Solana here. And full screen. Take the moving average. This do a 1 year, 2 years. And then you can do indicator Bollinger Band. I will do that in another video in more depth. But just to put in a picture, what is that? So there are many bands here. Let's take the Bollinger Band. And then they ask you, how many standard deviation you want to do? We'll talk about this later, but let's go with the default 2. So here, when the price is, the orange is the moving average. This is the upper band. This is the lower band. When the price hitting the blue is the price. Lower band, then this definitely here you have to buy. When you go above the upper band that overbought, then you have to sell. Again, it's a tiny windows you have to work here. RSI is another one. I'm going to teach it in a separate and more focus. Again, between 0 and 100, below 30 and above 70, you will buy. So the threshold is the 30 and 70. When you're near the 30, then oversold, then go buy it. When you're near the 70 or above, it's overbought, then sell it. 70 here and the 30. It's between the 30 and the 70. Divergence on the RSI. So RSI also has a momentum, so we can talk about the divergence. I'll talk about that in another video. And the disadvantage of RSI, which is a momentum-based trading strategy, it can miss out on potential profit because only if you are near the 30 or near the 70, you trade. But in between, it's a gray area, you didn't trade. And there is something called super trend indicator. Again, up and down. So you have a lower bound and upper bound, and you can do it. And you can develop your trading strategy based on this band. The idea, you take 2 standard deviation or 1 standard deviation between the upper band and the lower band. Now but here's also, I mentioned that an advantage of super trend indicator can have a great precise entries and exit. Works well with implied volatility is high, when the implied volatility is high. That takes me to the entry and exit analysis. This is important. Why? Because people think that they have to trade every day. No, sometimes you don't need to trade. You just have to be out. And sometimes you should not be out. You should be inside and trade. So there are two strategies for entry and exit. One is with the zigzag indicator. I'll talk about it in a minute from now or two. But first is the VIX is your fix. I have a research about that. I built a strategy based on the VIX. If you plot the VIX from 1990 till 2001, you'll see the VIX is a flat and up and a flat and up and a flat and up. So basically it's up and then go spike and going down and up. And then, so there is basically two regimes, regime 1 and regime 2. Regime 1 is the majority of the time is long. Regime 2 is spike. The idea here is you will exit. I have a couple acts here. The daily average return in the stock market when the VIX is above 23 is positive. When it's below 23, when the VIX above 23, the stock market going down. When the VIX below 23, the stock market going up. So here 23, that's a key number. The daily average return in the stock market is negative when VIX is above 23, then sell. If it's below 23, then buy. The average daily, and then if the VIX become to be above 70 and going down to 23, then buy. If become to be 27 or 30, above 30, then and going up, then you sell. Watch is Federal Reserve rates. When the Federal Reserve raises the rate, then exit. And do not trust oil prices. Sometimes oil prices high, that means the market heated up. That means it's good. But sometimes when the price is going up, also it causes inflation. That means it's going to cause rate hike. So don't trust the price of oil as an indicator, because the price of oil is driven from OPEC plus cartel, not from supply and demand, normal supply and demand competitive market. So here, as I said, I looked at the VIX during COVID actually, and I found that from February 21st till March 16, it went up a lot, and then the S&P went down 29%. But when it went from 82 down to 31, the stock market went up 30%. So be careful when the VIX leaving the 23 and going up, then sell, don't exit. When it hit above 70 or 60, then start buying. And then I'm going to talk the zigzag strategy. It's also in Yahoo Finance. Should be in the bottom. Zigzag. And the distance you can have in percent, and then save. And then here you can, when it reverse, then buy here, sell here. Reverse, go buy. When reverse, start selling. When reverse, so it's a longer stairs, either up or down. When it start changing the stair, then you go sell. And it gives you time to start making a profit. Like you sell here, and you get that. That's a zigzag strategy. I like it. It's simple. Easy to explain it. When using the zigzag indicator, you must set a percentage of a price movement. The default value, it's 5%. If the price going more than 5%, then that means there is something problem, then exit. If the S&P goes 5% quickly below 5%, then exit. If it's going up by 5%, then buy. This is a great method to filter or chop out chops. The lines on the chart are determined by this set of percentage. So that means the stairs are very, like here I did 10%, but if you do 5%, then your zigzag will be slightly different. If we do it, let's say 20% save, then you get that a little bit different ideas or inference. So that's pretty much. And then here I explain when using the zigzag indicator, you must set a percentage of price movement. The default is 5%. This is a great method to filter chop. Advantage can be a helpful to determine entry and exit, filter out market noise. Disadvantage, it's based on previous data and is not a prediction in a way in the future. Finally, you will have a set of questions. Sorry, I thought it's going to be short, but it wasn't. But you have questions that you need to answer, explain how the trading strategy works, Golden Cross, RSI, Bollinger Band, and others. That's pretty much what we've done for today. I hope you enjoyed the video. Thank you so much.